right, welcome to the March Economic Update. I'm John Cleaver, a partner and senior financial advisor. And with me this month, very special guest, Kelly Manning.
Hello.
Say hi.
Hello. Hello.
Yes, Kelly's 20 plus years financial advisor in the industry, and we're honored to have her a part of Beyond Wealth. She actually does something really cool. She has her own podcast.
Yes.
Called Women Going Beyond Wealth. Give them 30 seconds. What's Women Going Beyond Wealth about?
Women Going Beyond Wealth is a podcast that helps empower and educate women so they can take charge of their financial future. So it's an educational piece to just give them bits and pieces of the economy, of finance and investment.
Fantastic. So we'll try to find a way to get that information out to everybody, and we invite you to tune in.
That'd be great.
And listen to the podcast. So, all right, well, let's jump right in. So we've been talking about interest rates for a while.
Yes.
Grant and I talked about it in January. JC and I talked about it last month. I think initially some thoughts were rates could be coming down maybe sooner than later. But the Fed's been holding on a little bit. So, Kelly, what's going on with interest rates?
Well, it looks like the Fed is going to stay higher for longer than expected.
Right.
So we initially said at the beginning of the year that there would be 3 interest rates cuts in 2024. The market anticipated 6.
Right.
And so the market is now figuring out, nope, we're not going to have 6. It'll probably be 3. So at first there was going to be an interest decline in March. That's off the table.
Correct.
There's a high probability that there will not be a cut in May. So the question is, what's going to happen this summer?
Right. Okay. So how are the, we talk a lot about markets and economy when we talk about these updates. How's the markets responding to that kind of initial holding higher for longer?
I think the markets technically didn't particularly want it higher for longer.
Right.
The whole purpose of a rate increase is to get money out of the economy.
Right.
The market, by definition, wants money in the economy. They want it rolling. So the market, kind of was a little volatile as it expected the 6 decreases. And now we're seeing a little bit of a bump because they're probably going to be 3.
And as the market does, it tends to forward look and forecast.
Always.
So it'll price in whatever changes are made. But certainly, we've talked a lot about this idea of a soft landing too, right? And,
yes.
And I know there's some concern that if rates come down too quick, maybe inflation spikes back up. So I know that all plays into it. Okay, so that's the equity side. Just real quick on the bond side, like how are bonds responding to this kind of hold higher for longer?
Well,
the fixed income side.
When interest rates are higher,
yeah,
then bond returns are typically lower. So the bonds in the last couple of months have declined because the interest rates are going to hold. So once interest rates decrease, we can expect bond prices and bond returns to increase.
Yeah. It's all very interconnected, isn't it?
Everything is interconnected, John.
Oh, goodness. Yeah. So, one of the areas that we see and we hear people talking about is still this idea of inflation, right? So I heard it said the other day, getting inflation from 8 to 4 is one thing. Getting inflation from 4 to 2 is a much different thing. And that's really what we're experiencing. We've experienced, core CPI, even though it's easing, right? It's not easing at the same pace as it was before.
No.
And consequently, I know that that's caused some concern. And at the same time, unemployment has basically remained unchanged. We're still somewhere around 3.7%, essentially full employment. Most people, if they would like to be employed, could be employed, and therefore, the consumer continues to do fairly strong. So let's transition a little bit. Speaking of the consumer,
absolutely.
Are they still being resilient, or are they being tested? What's happening to the consumer right now?
I would call consumer confidence to be tested right now.
Okay.
And we're seeing that the consumer confidence is going down for the first time in several months.
Yeah.
And, consumer confidence is really defined as a present situation, what you and I look at our present situation, but also about the future. And for the first time, both of those things are declining in the average consumer here in the United States. You look at it and, the consumer right now is more worried about jobs. And yet we're at relatively full employment,
yeah.
and they're not necessarily worried about grocery prices or gas prices, and yet grocery prices have increased 25% in 4 years. So, there's a little bit of questioning with the consumer because, they think one thing, but in actuality, it's something else.
Right. And we've talked about this the first 2 months of the year, that really that consumer resiliency has that's really what's carried the market through some of these headwinds and some of this uncertainty of what's going to happen with rates and things like that. So, well, it'll be interesting. We'll definitely be watching to see what happens with the consumer, if they can remain strong through the spring and summer.
Yes.
Okay. Let's transition just a little bit. We don't talk a ton about global markets, although it is certainly an integral part of what we do in terms of managing assets. And so we thought maybe we would touch base on that just a little bit. Maybe kind of under the radar a little bit, but global equities have actually rallied now 4 months in a row, fourth consecutive month, kind of the longest winning streak we've had really since 2021.
Yes.
So what's happening globally, and also, is the mega tech thing, the Magnificent Seven thing, really going away, or where are we at with that?
Well, I think, the continued strength of the Magnificent Seven is certainly helping, because that equity rally is from China and Japan.
Right.
So the investors are starting to think that, hey, maybe the Magnificent Seven is here to stay.
Right.
So it's just really interesting to see, but that the Magnificent Seven has not only helped U.S. equities, but it has also helped those global equities as well.
Yeah, and I think, as we continue to see the large companies, right, those biggest companies continue to outpace, tends to favor U.S. over global. But certainly that global is getting our attention a little bit, right? And we're paying attention to that for sure. And at the same time, we're also seeing what we talked about the last couple months as well, this broadening of the market. So while those mega techs continue to do well, we're seeing some strength, kind of across the board in some other areas also.
Well, John, I think, even to take that, a little bit, I don't want to say dumb it down, but when we talk about broadening of the market, last year we can use it as a really good example. The market was very small because the Magnificent Seven did so well that those returns pushed up the S&P 500.
Right.
Now, instead of just those magnificent seven, you now have broadened the market to 11 sectors within the S&P that are actually doing well.
Right.
So that's what broadening of the market means, and that's why that's such a that's a good indicator that it's not just those 7 stocks.
Yeah, I think that really speaks to this idea of if the recovery is broader, then this idea of a soft landing comes even more into play, because more aspects of the economy have the opportunity to do well going forward.
Correct.
So, and then another area of kind of global equities we don't spend a lot of time on, although it is a part of most of our portfolios, and this is this idea of emerging markets. And we're actually, lo and behold, we're finding just a little bit of traction in the emerging markets area. Even a little bit of outperformance over some developed markets. So I think that's a good thing as well, just as the global economy, kind of comes into shape as well.
Absolutely.
So, all right. Well, that's a lot. It feels like a little bit of a continuation of the story that we've had, and I think we're probably going to have that as long as we're still dealing with, kind of what's going to happen with interest rates. So. I don't know. Are investors a little less calm, a little more calm? Are they a little less easy? Like, what do you think going forward?
I think the investors are kind of sitting, waiting to see what's going to happen. What's the Federal Reserve going to do? And not to go down this whole rabbit hole, but what's the election going to do? So we've got a lot of clients, a lot of investors who are just kind of sitting, waiting. Not really, want to put the toe in the sand, but necessarily not jump in the water fully.
Yeah, That's a great way to end.
Mm-hmm.
Well, we thank you for watching this month's economic update. And as always, make sure you reach out to your advisor. I know this is a busy time of the year, tax season, lots going on. But make sure you've got your plan in place for the year. Make sure you tune into that Women Going Beyond Wealth podcast. And we look forward to seeing you back next month.